Okay, good morning, everyone, and you're very welcome to this morning's Coffee Microcaps morning meeting. For anybody who's joining us for the first time, my name is Mark Tobin. I am the founder of Coffee Microcaps, and you're very welcome to this morning's event. For all our regular attendees, good to see you on another webinar here. I'm going to quickly jump through these intro slides, and then we're going to get straight into it with our first presenter. I would first like to mention RAS Research or Service, our sponsor here, Coffee Microcaps, for all our events. If you are looking for some coverage of small and micro cap companies, please jump on their website where they have some free research available, and they also have a paid premium option now as well. And of course, we couldn't forget our good friends from ASIC. A very warm welcome to them as well, if any of them are joining us on the call this morning. For anybody who is joining us for the first time, the companies we tend to have on here, capped under 300 million, our definition of a microcap, in revenue, approaching cash flow break even, or indeed are already profitable. We tend not to have companies from the resources and biotech sectors. We have then what I call industrial microcaps, which kind of covers everything else from technology, healthcare, financial services, hardcore industrial businesses, professional services businesses, kind of everything that falls out of the resources and biotech arena. Structured this morning's webinar, we got two companies this morning, and I should say two, not four. Two companies this morning, which will break down half an hour each. 20-minute preso, 10 minutes of Q&A. If you do have any questions for our presenters, please type them in the Q&A box rather than the chat function. Just makes it easier for me to moderate the questions to our presenters. And please note the webinar will be recorded and posted on the Coffee Microcaps YouTube channel. It'll be up on Monday. And indeed, we had a session yesterday, which has just gone up on the YouTube channel if you want to check out yesterday's session where we had four companies presenting. As I said, you can follow us on Twitter, YouTube, LinkedIn, and our monthly newsletter will be going out towards the end of next week. Our first company presenting this morning, I'm delighted to be welcoming back Grant Straker from Straker Limited. Grant's been presented here a few times before online, and he's a bit overdue an update with us. I think he last presented at our in-person conference back in Sydney. I think that was March 24. And then after Grant, we will have a first-time presenter with us, Josh Simmons from Vinyl Group. But I am going to stop sharing my screen and I will hand you over to Grant. As you can see, Grant is trying to psych me out here with his All Blacks jersey on ahead of tomorrow's game in Chicago.
You should
Yeah,
be seeing that now.
It's just loading now, Grant. Yeah, I can see the cover slide, Grant. You can take it away whenever you're ready, mate.
Okay, thanks, Mark. Welcome everybody to this update. It is a bit of an opportunistic update. We had a release out yesterday around renewing of a major contract with IBM, and we just thought it was a great opportunity when this slot became available to just expand on that story and to give an update on Straker overall. The one thing I'll just say at the start is that we're currently in blackout. We're a New Zealand financial year, so we're March 31 year end, and so we will report our results in a few weeks' time. So we've just got the auditors in and everything else. So I can't talk too much about numbers, but we can talk about where we're at with our technology. So I guess the way that I'm phrasing this, because it is a bit, I have got a cup of coffee, and it is about just, I guess, an informal way to talk to investors. This is, if my pitch is anything, it's an AI re-rate opportunity, and I'm sure over the coming months and year or two that you're going to start to see these sorts of opportunities come out as you start to try and decide who's going to win in the AI race and who's not, and who's maybe behind the pace and where everybody sits. So that's really the way that I'm positioning this. Just let me get into here. So First of all, for those of you that don't know Straker, I'll just start with a few numbers. So this was from our full year, but we have a reasonably balanced register with institutions, high net worth, a good portion held by founders and management, and a good portion of retail. So that's what I'd call a reasonably balanced um, cap table. And I'll just come across to some of the numbers from our full year last year. And if I start at the bottom and work up, we had strong gross margins. We've got zero debt. Um, Invested a lot into R&D. Strong operating cash flow. Um, a very healthy balance sheet in terms of cash in the bank. Reasonably positive number on our adjusted EBITDA, and just close to 45 million in revenue. Now, just under that revenue number, it's not deliberately small. It's just the font that was used at the half year, but that's our guidance for FY26. So I'll just cover that and put that right out there, that our guidance was 38 to 41 million, so a drop in revenue. Now, we did say at our AGM, we were reasonably positive on the higher end of that guidance. Obviously, a few months to play out on it, but we are obviously announcing a few reasonable deals. And I think the thing to think about um, with a company that has a declining revenue is, and I know this because it's the feedback I get, are you on the road to zero? Is it just all downhill and and where does it end up? Or is this similar to what happened with the SaaS companies, say 2008 to 2015? A lot of companies had to transition. And whenever you get a transition of technology, you get a change in the pricing model. And SaaS is the best example of this, right? Like you went from enterprise annual license fees into monthly, much smaller recurring revenue fees. And I know that for many analysts and investors, that was very hard to navigate, to understand what was happening. And you did see companies where their revenue dropped off until they got to that state where they've gone through that transition and the new pricing models embedded and the new world order of how technology works is working. And then you start to see an increase. So an industry that's been at the forefront of AI disruption. We didn't see AI as a productivity tool so much. We see it, we've always seen it as a threat of replacement. And so that's where we've done a lot of things to make sure that we can really benefit from it by understanding it. And I think you'll see in your portfolios many companies going through this sort of transition as they start to go from AI being something where they thought it might add productivity to something where it might actually replace them, where it can write whole software programs. So it's a very interesting time. So just some recent proof points. Where we had record profitability last year. We're well managed. We sort of know what we've got to do. But in the last couple of months, we won a European tier one software company contract in August this year. And look, that company didn't want to be named, but you would all know its name if we said it. Major contract, just close to 5 million over 2 years, and just just validates our position in the industry, and that we have some really relevant technology and reach right now for some of these really big customers. And announced yesterday renewal of our contract with IBM. It's anticipated volumes, and revenue around about 28 million over 3 years, effective from January the 1st. But importantly with this one, it's not just about renewing of that contract, which has depressed our share price. I feel like it's been a common comment from people that they saw if we didn't renew IBM as a major risk, right? So that risk is taken off the table, so to speak, and now we can focus on what it means. And look, it does give us an expansion into a deep AI co-development partnership over the next few years. And I'll talk a little bit more about the IBM opportunity as we go through. So a little bit about what we do. We've come out of the translation industry, and they're called large language models for a reason. They're around language, and that gave us a significant amount of experience in machine learning, in building um, models, and how to train models, and building up a technology team that actually knows how to build AI models. Um, and we could see that what was going to ultimately happen in the AI space was that data is going to be the new oil, and that people are going to need a machine to run all of this oil to be all of this data to give them a competitive advantage. Because ultimately, if AI, and I think something like 45% of all AI requests are related to coding and building code. So if AI can build apps really easy, you're not going to get a competitive edge building an app. You're going to get a competitive edge by having a model which outperforms a generic model. So outperforms an OpenAI, ChatGPT or whatever. So, and this is reasonably mature thinking now. I think people understand that this is the way that it works. So we built our own proprietary Terry model, um, and we've deployed that inside of IBM. We're deploying it with a range of customers, and this gives us the ability to train our data sets and to get better results than what you would get out of a generic model. And then from there, we're starting to see the opportunity to co-build small language models on our platform and on our and using Turi as a base. So if you talk about a small language model, a it's not that there are small, it's maybe there's a trillion parameter model, and then there's a 300 billion parameter model. What we're talking about here is maybe from 500 million up to a couple of billion parameters. That's what you would classify generally as a small language model. Now, so what there are a number of these foundational models that do different things. Some might be good at image recognition, some might be good at voice, some might be good at video. And what you're doing is you're finding the use case that the customer needs, the problem they need solved. You're getting the right foundational model. You've got a process to tidy up the data, make sure that it's in the right format to answer the questions that they want answered from that model, which is normally very specific to a subject domain or use case. And then you train that model very specifically to do that job. And this is going to be a massive industry in my mind, right? And certainly that's where we see the opportunity, because a lot of it is around sort of garbage in, garbage out. If you don't get the data right to train it and to answer the right questions, your model will produce rubbish and it will hallucinate and it'll just have the wrong answers. Now, obviously, what we've got is a whole crowd of 10,000 humans who are experts in lots of subject domains. So we've actually got a platform already that can start to fine tune that data. We've got the technology team that knows how to build these models, and we've got proof points now where we're starting to see that happen. So that's one part of it. And again, we have Turi as our foundational model. We have Verify, which is our verification product. And there are a few different forms of Verify. There's a sort of transactional consumer basing version of Verify. There's an API utility version of Verify. But Verify is saying that no longer would you do a machine translation and then tidy it up. Now what you're doing is an AI translation, and then you're verifying that those segments in that AI are correct. And a lot of that verification can be done through other language models, right? So through verification models. And then you still need the human feedback loop in there. And this is where we have a pool of humans that are experts that can verify what people need. And there's been a lot of, well publicized issues around non-verification of AI and how it can make mistakes. So again, then we have, Turi as our base model. We have Verify as that sort of user experience way that application gets applied. And then we have a product we call Supercharger, which is really saying that we have these humans that then validate that the output's right and then feed it back into that model. So you get a continuously improving loop. And, there are companies like Scale AI that Meta bought for 30 billion. And that's not a million miles away from what their technology did in reality, right? This sort of process. And we have that technology and we have that team and we have that experience. So just quickly, and again, just coming back to, if we have this, is this an AI re-rate opportunity? As I just said, companies like Scale AI, massive valuations. But even just in general, if you look at where we sit, obviously what we can, the way that the market sees us at the moment is that we don't have technology. We're not sitting in a good place, and that we're valued, even below some services-based companies. With an EV of 7 or 8 million, when you've got 40 odd million of revenue, it goes against the fundamentals of what we see. And so there is an opportunity off the back of this IBM deal as we start to work closely with our IBM partnership, and their approach is very similar to ours. They want to go out to their customers and offer them AI solutions, and it's been well publicized how well that is going for them. Just in recent weeks, that there's been significant Gen AI order book for IBM. So obviously we want to be in their coattails, and we want to be offering our solutions. Now, as we start to do that, and let's just say in 6 months' time, 12 months' time, is that starting to kick in? Will we get re-rated, or will the market still think that we are just a services company that can't deliver it? And I would say that IBM haven't re-signed the contract with us on AI terms because they think that we're just a services company. They've done it because they understand what our technology does. So I'll just come back to my last Coffee Microcaps as I just fire through these last slides. But this is what I put up in March last year. I said there'll be industry consolidation. Translation will become a utility, not just translation, many services will become utilities inside of workflows, right? You'll get margin expansion as these things become a service, and you don't need to have the OpEx overhead and the human overhead and some of the stuff. Companies, and this is particularly to the translation side of what we do, companies will move away from managing translation processes and they'll be embedded AI solutions. And as I've already mentioned, there'll be new pricing models. So you're going to evolve same way that SaaS did from a enterprise to a monthly fee. You're now going to token consumption-based billing, and this again has been well signaled in the market that this is happening. So all of these things we predicted. This is what I predicted in that in March last year. And look, that vision has become a reality. And we had record margins last year, but I think overall you'll start to see companies, once they've transitioned, start to get very strong margins. And again, it's hard for a company in transition because you have legacy margins and then you have your AI margins, and they all get blurred. So I think going into next quarter, or certainly into the first quarter of next year or the second quarter, as we start to see some of the IBM revenue come through on the new token-based pricing, we'll start to report on that. Consolidation absolutely is happening. We've got new pricing models. Again, our pricing model with IBM now, 3 years after we did our last one, is all based on token billing, right? So again, we had to build a token billing engine, which we did a couple of years ago, and that's the way that these companies want to deal with their vendors. And there'll be a platform shift, to embedding this stuff into core technology. So just quickly, again, this is on the thesis of AI. Like 71% in Q1 of this year of all the VC money in the world went into AI. And I guess what I would say to investors and analysts is, are you in line with that, or even halfway there, or are you at 10%? It's very difficult at the moment to get access into listed assets that are strong in AI because they're all private companies on the whole at the moment. And we're one of the few listed companies where you can get access into an AI asset, a true AI asset, where we've got this. 36 billion in infrastructure so far this year alone. Like the whole SaaS revolution was something like 225 billion. across 7 years. And this is just on infrastructure. It's the reason NVIDIA are the world's most valuable company in the first $5 trillion market cap. There's a lot of very smart people investing this money because they can see that what's going to happen in the next two couple of years is that applications are going to be built on that infrastructure are going to completely change the way that things work. And what we're dealing with now is the infrastructure from 2 years ago. I mean, this is at a whole nother level. So, moving fast and being at the heart of an AI ecosystem's critical. And so this is why IBM for us is really important because we have a major partnership and our technology and our models run on their platform. And so, we're very aligned with getting the right outcomes. Um, so a quick dive on the partnership. We go from a vendor where we were delivering mainly translation services to one now that's a fundamental shift, right? We're co-building IBM's future and embedding our technology into the Watson ecosystem. So we're co-building small language models. We've already done one for them around IP up in Japan. We have the opportunity now to partner with their channel partners on solving models for building models and solving and using AI to solve problems for some of their customers. So great opportunity for us. We've got our Turing models deployed on Watson. Watson's actually because of its security and its compliance and the stuff that enterprise customers really love. It's not a simple platform to deploy on. You've got to have a certain skill set to get that on there. And that's all part of the IBM story, right? They don't want anybody just deploying all sorts of models. They want the right type of models. So ours can run there. So it makes it very sticky once you've got your models inside of there. We're securing compute capacity. There's a lot of stories about like compute capacity for AI reaching some bottlenecks in the next year or two. By partnering with a global hyperscaler, we're locking in that we've got that compute infrastructure. A little bit on the go-to-market around that we're trying to do with IBM. Like, we're not just going to walk through the door and IBM are going to chuck us lots of customers. We have to work at this. We have to have the right systems in place. So we're working from a service provider to embedding our technology inside of their ecosystem. So we're looking at agents that are purpose-built for IBM Watson Orchestrate and can be plugged straight in. So IBM have Watson catalog, and it's their services guys that go out and sell this and sell their solutions into their customers. If you're inside that catalog, it's very easy for them to go, right, we need to add this in here. We need a model that does this, and they click a button, and we're inside of there. So that's a part, again, this is a new contract. We're just moving into this. It's not live today, but this is where this takes us. And then we're looking at Turing agents that are powered by Watson. So again, as we build solutions for customers, they run on IBM's Watson ecosystem. There is an incentive for IBM sales reps and the IBM solutions team to use our solution because our models will run on IBM infrastructure. So, this is a massive opportunity for us. And just into the last, well, that was the last slide, which I think is on time because I meant to do about 20 minutes. So I will pause there and just come back for any Q&A.
Thanks, Grant. You can actually leave that last slide up there, Grant, to give people a chance to
Okay, all right.
just to take down your email address and stuff, maybe while we're talking through a couple of questions here, rather than
Yeah,
just rattling it off at the end here. Um,
yeah.
just yeah, I will say, as Grant kind of said I've saw enough of these as well over the years, that transition from annual licensing fee, big enterprise deals to SaaS type billing models does cause no end of confusion for investors, no matter how many times I've seen companies evolve through that process over a kind of a 2 or 3 year cycle. It does cause a lot of confusion. So I'll agree with Grant on that. Grant, you talked about the the deal now with IBM. If I remember correctly, I think they had their results out last week for Q3. Did they touch on anything in their Q3 results regarding, what they're seeing from AI in their kind of latest results just since they're fresh?
Yeah, look, I don't have them in front of me. I did see the post, and it was something like 9% growth in their AI, and then a really significant growth in their Gen AI order book. So, they really are starting to see that. And I think we all know it, right? Like they've got these big enterprise customers. Everybody knows you're either right in on AI or you're out of the race. Like AI is a velocity play. And so they've got all these customers now with this massive demand suddenly coming through to integrate solutions. And one of the good things about IBM is, they're agnostic, right? Like if you go to OpenAI, you're getting OpenAI. If you go to Amazon, you're getting Amazon. If you go to IBM, you could get all sorts of different solutions put forward to you. And so that I think has a lot of appeal to to a number of enterprises. So they are seeing a significant growth in their Gen AI order book, and obviously we're trying to ride on those coattails. We're trying to anybody that needs, for example, just out of the box the translation stuff, we can build models for specific domains, but we can also build models that are not related to translation that might be about travel or legal or anything else. Yeah.
Yeah, you mentioned I think patent law there on one of the
Yeah.
slides as being the small language models.
Yeah.
My wife works in marketing, and I know one time she had a client in the healthcare space, but she was just blown away by how much medical copywriters used to charge the clients because it was such a specialized field within copywriting, and if you didn't know what you were talking about, from all sorts of like regulatory compliance issues, you couldn't just like write anything you wanted. So I mean, there's probably another maybe application. But in terms of, I just want to get back to pipeline as well. You talked about the European one. Obviously, IBN has come on board now. Should we expect to see more stuff come through the sales pipeline as we push into 2026 on the back of now having IBM locked in? Does that kind of speed up the decision for kind of other customers now that you've got the kind of IBM partnership in place?
Yeah, look, I think there's a reasonable chance of, another announcement or so, maybe before the end of this calendar year. So, there is a lot of activity. And again, you can't guarantee when people sign or move or what's going on. But I think now there is um, an understanding that people need to move quickly. And probably for the last year or so, people have sat on a fence because they're trying to waiting to see what technology was coming out and what was going to happen, and they've tried to balance it. And I think now it's critical. So, look, as we go in and this is released, yeah, I mean, we are certainly aggressive in our approach of getting deep inside that IBM ecosystem, getting our platform in there, getting in the catalog, and and then really, we are set up to scale. We have 170 staff in 10 countries. So it's not like we have to be a startup and win these opportunities and then try and figure out how we put the infrastructure in. We've already got the infrastructure for very rapid growth. So it's very exciting times. Like this is the most exciting time I think we've had for just about 20 years, I think, in terms of technology. Yeah.
And in terms of what this will do to Straker's margins, if we take a 3 to 5 year view, obviously there's going to be a bit of noise here and there in various results, but from where margins are now, long term, is this a structural tailwind to like improving margins?
Yep, I absolutely, and that's a good way to frame it. Like a 2 to 3 year way to look at the margins is I think an accurate way because there are still going to be companies that still hang around in this legacy world. Like, they're too big and they don't move and they've just got systems in place. And so you'll always have some of this legacy. But I think in 2 years, I say 3 years time, absolutely, then everything's going to be on the AI front. And so, but if you look long term, like would we be software level margins? I look at a company like AI Media that's about 80 something percent gross margins. Absolutely, that is something that is very feasible as you get your whole customer base across to an AI type solution.
AI Media, yeah, we've had Tony Abrahams on here numerous times. You can check him out on the YouTube channel. But I think I
Yeah,
was thinking about AI Media when you were talking, Grant, because the integration of AI into their closed captioning software offering, has been like a game changer for their business. And I think at the start, a lot of people thought AI was going to, completely disrupt their businesses, actually enhance their business over the last kind of 2 or 3 years as they've integrated AI into their like product offering, and it's actually like help them win more customers or do more with customers rather than less. It's actually a good
oh,
example to maybe mirror with Straker, if I can say that.
correct. Yeah, no, look, absolutely. Like they are, a great comp because if we can follow, and they've executed incredibly well, right? They've executed the whole thing, and that's our mission right now. That's the mission with our team. We've got the technology, we've got the channel, we've got the partners. We've got a strong, healthy balance sheet. So, let's execute a very similar game plan of moving legacy into AI, increasing margins, and hopefully we would get a similar result. Their share price has shown over the last year or two.
Yeah. Grant, we are just up on time. So I think we leave it there, and then hopefully we can get you maybe back in a couple of weeks after the result is out, and you can maybe add some numbers to what we saw here this morning.
No problem. Thanks for having us, Mark. Great to talk again.
No problem, and I'll say good luck for tomorrow as well to Grant and the rugby, and we will we
Don't
will.
mean it.
I'm saying that through great speech, Grant. We'll hand over to our second presenter who's been waiting very patiently in the wings there, Josh Simmons from Vinyl Group. Josh, good afternoon, I should say at this stage.
Hello, how you doing?
Very well.
You
Yeah, I can
see
see
my
your
presentation there?
presentation there now, Josh. If you
All
want to,
right.
it looks, hold on, it looks a bit. You on full screen, Josh? Yeah,
You've
just.
got full screen there?
Yeah, now there we go. Yeah, we were only seeing kind of the top half of the cover slide, but you can take it away now. It looks great.
Beautiful. All right. Well, thanks, Mark. And hello, everybody else. And thanks for joining. I'm Josh Simon, CEO and Executive Director of Vinyl Group. So I first joined this business a few years ago when I sold my US-based music tech startup Vampr to what was then called Jaxsta. And shortly after that acquisition closed, I took over the company as CEO and kickstarted a period of rapid growth and transformation. Particularly like the last 12 months, Vinyl Group, it's changed significantly. We've made 4 acquisitions, established 2 operating divisions. We really reset our growth strategy, and now we're on a clear path to profitability. So what we're doing is building a sustainable business model in a lucrative niche, and we believe this has long-term international growth potential. So I'm excited. I'm excited to share this with you today and show you what we've been up to, and most importantly, where we're going. So as we sit here today, following the integration of these recent acquisitions and a refined growth strategy, we really think there's about 7 key reasons why investors should take a good serious look at Vinyl Group. Firstly, we've got a unique business model with diversified revenues and high growth music and culture segments. We have a large and growing fan and creator community, which is really important foundational asset. And we've got multiple ways to monetize this community through our integrated publishing assets, as well as our platform technology capabilities. Second, we are scaling revenues and growing really fast. Revenue is up 190% in FY25 to $14.4 million. And this was made up of both acquisition growth and organic growth. And subsequently, in our Q1 update, we reported quarterly revenues of $4.9 million, which is up 37% quarter on quarter. In FY26, we're targeting revenues of 25 million, which would represent organic growth of about 25% on top of the full year contribution from previous acquisitions. Importantly, we're also investing in initiatives to accelerate future revenue growth, which would push us beyond that $25 million revenue run rate in the years ahead. And our big focus for this financial year is margin expansion. So we've said repeatedly over the past year that we are implementing initiatives to structurally lower the fixed cost base. In the first quarter of FY26, our underlying operating cash flow, which excludes some one-off costs, was down 65% year on year and down 53% quarter on quarter. So we're obviously moving quickly, and we're on that right track. Now, we're also a technology company at our core, and I'm a technologist and a builder at heart. So with our internal technology capabilities, we've been building a proprietary AI publishing stack. And the whole purpose of this is to automate the mundane tasks associated with publishing quality content so that we can increase volume to meet the demands of our fast growing viewership. Now, this is a really exciting part of the business, and I would say watch this space. We have premium positioning and a comprehensive access to high growth music and culture segments. And this means that we can attract advertisers and brand partners. And we also have a fast growing network of agencies driving new brand activations. So if youth brands such as Adidas, Apple, McDonald's, Bonds, Disney, Lego want to access the youth demographic in Australia, then they or their advertising agencies are increasingly coming to vinyl to execute those campaigns. Now, the global opportunity is significant. We see many opportunities to expand the monetization of the music and culture segments internationally through expanding, first through our platforms on the technology side and over time into publishing. The business is now at a near-term profitability inflection point, targeting our first EBITDA positive quarter in Q2, which is a really big operating milestone for this company. Now, digging a little bit deeper into the business model and what makes us unique. So in the middle of the diagram here, you've got our flywheel, which consists of fans, creators, and brands. These participants are sort of at the heart of everything we do. And as we keep engaging and building this community, we believe we've got the largest audience in music and culture segments in Australia, with obviously a growing audience internationally. And what makes Vinyl Group unique is our ability to monetize the transactions between these stakeholders in a multi-directional ecosystem. Our publishing business has an extensive network of media assets, and we generate revenues in this division through direct sales, events, and programmatic advertising. And you can see, with the mastheads and the names here, some of these are brands that you'd obviously recognize: Rolling Stone, Variety, Refinery 29, Media Week, etc. On the other side, the platform division, we provide the underlying data, identity, and commerce stack, as well as AI publishing capabilities to reach a global audience. So here we have brands including vinyl.com, Vampr, Jaxsta, and Serenade. And we generate revenues in this division from advertising, e-commerce, and subscriptions. Now, as we keep going deeper into the heart of this circle, here you can see how we are building scale with brands, fans, and creators. We currently reach about 10 million fans monthly through our publishing assets, and we have over 1.6 million registered platform creator accounts. This fan and creator community, it's becoming an increasingly valuable asset. And it becomes valuable not just obviously to the business, but to the brands and advertisers that you can see. Obviously, there's a fair few big ones here that we work with, and they work with us because we provide them with access to this youth and culture community. Think of some recent examples. We've done some really cool activations with Mentos, Posca Hydrate, Philips One Blade, and these activities are generally centered around sort of national cultural events like the AFL Grand Final in Melbourne or South by Southwest in Sydney a couple of weeks ago. Now, if we take a step back and look at the sort of broader competitive landscape, you can see that vinyl has a unique position in our content niche, and that this market is underserved by traditional players. In terms of industry size, music's just an enormous industry worldwide. Goldman Sachs forecasts that I think over 1.2 billion consumers will pay for music by 2030 in the next 5 years. And media research estimates there will be nearly 200 million music creators globally. So therefore, vinyl sort of has a large and fast growing global addressable base for its publishing and platform services. But from a defensibility standpoint, we believe our competitive moat really lies in the combination of bringing this existing media influence that we have with our proprietary tech infrastructure into an integrated ecosystem. And the reason why that sort of provides a basis for a sustainable business is that it offers advertisers more views at a lower price point across an extensive media and technology asset group in a lucrative niche. So we're really sort of happy with our foundational assets in this respect, and now we're focused on scaling that. So let's take a deeper dive into each of these divisions. We'll start with publishing. The publishing division was launched as Vinyl Media in February 2025, so it's only 8 months old. Now, we operate 8 mastheads, and in addition, we manage the content and ad inventory for over 40 websites. Since this launch in February, our multi-platform views have grown in a hockey stick fashion, up over 250%. We are investing in high-profile editorial content. We have trusted and timely news flow in the culture niche, and we're regularly breaking stories on the latest tours, industry news, and we run flagship events on top of that and brand partnerships. In FY25, this division generated over $11 million in revenue, which was up 258% on the previous year, driven primarily by acquisitions, and we expect this continued growth through FY26. Here you can see the mastheads, in addition to those 40 websites I mentioned that we manage the ad inventory for. Now, over on the platform side, the platform division includes 3 or 4 different technology platforms. Firstly, Vampr, which is the business that I founded in the US, and it's a social professional network and talent marketplace for the music industry and an ecosystem with 1.6 million registered creators and users in over 190 countries. Vinyl.com is our premier e-commerce platform that we launched in 2023 and now has over 50,000 titles and expanding. You've got Serenade, which is a pioneer in physical digital collectibles. And it's served over 200 global artists, people like Lewis Capaldi, who was another big one we had recently. Is it Shania Twain? Lots of sort of A1 type artists, and it serves as our access point to the UK and more broadly Europe. In combination, we have market-leading in-house technology capabilities, and as I mentioned at the start, we're sort of continuing to invest in new products and processes. We're always looking for ways to leverage this internal tech capability and a growing tech stack. This division generated 3.3 million in revenue in FY25, and the focus here is on continued organic growth. Here's a look at Vampr, Jaxsta, Vinyl.com, and Serenade. Now, let's talk about strategy and outlook. So looking forward, we've got 3 growth strategies in the publishing division. Firstly, we want to keep increasing our media assets. We've got a great portfolio at the moment. We want to keep building on it. We become the main aggregator of iconic music and next-gen titles here in Australia, as smaller players in the market are looking to exit. So we have the potential to add another 1 to 2 mastheads in Australia in the next 12 months, and we're looking at ways to leverage the Rolling Stone variety brand halos into new commercial opportunities. Second, we want to further integrate programmatic ads in order to capture the agency spend, which is shifting to automation, and also improve our own margins via supply chain control. Thirdly, we're looking to expand content we're calling it Project Automate, but it's our AI publishing project. And this project will help us scale content across our various mastheads, unlock personalized content to deepen engagement. And we've been sort of building this stack for about 12 months with the goal to increase output by 10x at the end of FY26 with basically a lower marginal cost of content creation. The whole publishing division is aligned around these 3 core strategies, and we're really pushing ahead with all these initiatives to turbocharge growth. As I said earlier, especially on the AI front, watch this space. On the platform side, again, we have a 3-pillar strategy. First, we continue our focus on minimizing customer acquisition costs. We want to reduce the payback period and boost the long-term value of our customers. And we are looking to drive growth via strategic partnerships and new channels. Now, from a tactical perspective, we are building upon existing viral and organic growth loops to drive referrals, and we're experimenting relentlessly with pricing and optimization of key conversion paths. Secondly, we're expanding our e-commerce product range on Vinyl.com. We're exploring hardware inventory in addition to exclusive releases, and we will increase the direct sale of high-margin SKUs around collectibles and bundles. Thirdly, we rally around product-led growth, with data informing our go-forward decisions. As mentioned, we are integrating AI and automation into every part of the workflow of businesses, and we're beginning to look into AI-powered music collaboration and discovery on the Vampr platform. So the possibilities here are endless. They're exciting because of the first-party data that we already collect on our fans and creators across the entire Vinyl Group ecosystem. But to use that to further drive personalization and engagement across the platforms is an area of focus, and certainly spending some R&D money on it. We have big ambitions and a detailed growth plan across both divisions. I'm excited about the growth potential of both of these over time. Now, looking back at our FY25 performance, we're pleased to report revenue growth of 190% to 14.4 million, which, as I mentioned, reflects both acquisition and underlying organic growth. We've acquired 4 businesses in FY25: Media Week, Funkified, Concrete Playground, and Serenade. Now, the pro forma revenue in FY25, if all of those businesses had been around for that whole year, was nearly $20 million. So we now have these foundational assets in place, and with our 2 operating divisions, publishing and platforms, the focus is really on streamlining this business and improving productivity. Another highlight to note here is that our balance sheet's relatively clean, with $8.9 million of debt converted into equity in FY25. So the focus on this financial year, FY26, is on profitability and reducing cash burn. In Q1, we reported strong revenue growth and a record revenue quarter of $4.9 million, which is up 37% quarter on quarter. We're currently in our seasonally strongest quarter of Q2, so we can expect good top line growth again this quarter. And you can clearly see the results here of the disciplined approach to cost control and this relentless focus on operational efficiency in the graph, which we've been talking about for some time. We've consistently reduced cash burn over the past year, and we remain on track for an EBITDA break even in this Q2. So we're targeting revenues of $25 million for the financial year, and this would represent organic growth of around 25%. I think the key thing here is once we prove this model, we will again be looking at acquisitions to accelerate the scalability of the overall business. All right, so looking ahead at several upcoming catalysts, we have our break-even milestone in Q2 to look forward to, followed by half-yearly results, which should really validate the scalability of the overall model. And if these all go to plan, it's reasonable to assume that we'll continue the growth through continued organic momentum, further acquisitions as mentioned, and global growth into FY26 and beyond. The tech issue. The company is led by an experienced board and management team, and it's supported by a tightly held share registry with the top 10 holding 73% of the shares on issue. Thank you for your time today. It's always a pleasure to speak about the unique business model, tell a story about how we're scaling the business while improving the margins. It's an exciting period, obviously, as we finish the year stronger than ever, and with expanding viewership numbers and a growing list of brand partners and advertisers. It's really exciting to think about the potential here with the global growth and obviously hitting this near-term profitability goal. So with that said, Mark, I'll cast back to you and do your best with questions.
Cheers. Thanks, Josh. Good to actually, Josh, can you just pull that slide deck back up and maybe just leave Katie's details there just while we're chatting in case anybody's got questions offline or want to get in touch maybe early next week or
Absolutely.
We can just leave that there. In terms of the acquisitions, you talked about maybe 1 or 2 mastheads. Does that also extend into other kind of website domains as well? And is that with a kind of a greater plan to maybe you can consolidate them? I'm just thinking, my brother is a huge Nordic death metal kind of a guy. And obviously if you've got kind of 2 websites which are doing those and they've kind of got their own kind of customer bases, would kind of make sense to put them all under kind of one banner, maybe the bigger or the smaller one, kind of 40 websites. I know they're probably serving different genres, but is there possibilities of putting them together? Is that the plan, or is it really maximizing those customers on those, whether it's on the masthead side or the website side with the advertisers to say, hey, we've got a very niche audience here, and you kind of need to pay up for that niche audience.
Yeah, so let's be very clear about how audiences work on each side of the business. So when it comes to the ad network and we talk about the 40 websites represented, we represent those businesses. So we don't operate those websites. All we do is place ads on those sites, and that's we actually want them to be as independently big as possible. So it's not our job to convince the independent owners of each of those to come together and create a super site. It actually works a lot better for us to let them build their individual platforms with their own unique audiences, and then we can offer those to advertisers. So we want that network to be as broad, and that's how you get strength in that sense. When you look at the platform side of the business, which is our technology plays, it's absolutely reasonable to assume that consolidation is a positive thing on that side. So over time, and we've done a bit of it already, we've brought most of Jaxsta capabilities into Vampr now. We're starting to bring some of the Serenade capabilities into vinyl.com. So it's very reasonable to speculate that over the next couple of years or so, consolidation on the tech side becomes a feature. But on the advertising and media side of things and publishing, we like that diversity. It actually makes the business far more defensible.
Okay. And just that you touched on the e-commerce bit. Is there just tours are just like so massive now, and that's actually where artists kind of make their money these days, rather the majority of their money rather than on the streaming and actually buying albums and stuff. Is there an opportunity there to white label your kind of e-commerce offering where it looks like you're buying something from a Lewis Capaldi tour, but you guys are handling all the fulfillment, everything in the back end for the artists themselves?
That's what we're already doing. So Serenade business is a white label business.
Okay.
So when Lewis Capaldi does an activation, or J Lo, or any of the people who have done it recently, they don't see our sticker on it. It's very much a B2B white label business. Vinyl.com is the storefront that our consumers and fans deal with. And bringing some of those Serenade products into Vinyl.com is an opportunity to obviously bring higher margin products into a store that we own and control. But as far as how we actually get artists to commission those products in the first place and sell them, we're giving them that white label product. They're first and foremost selling them through D2C channels, and then we're hoping over time that we can start to sell some of the overstock and through our own B2C channels. But yeah, that is a white label model predominantly at the moment.
And a pure SaaS model, or do you take a clip of the revenue that goes through as well? On
On
Serenade.
that yeah, no, on that business, no, it's pure SaaS.
Okay.
But yeah, again, I think that the motivation to sell that overstock through vinyl.com sort of gives you a second clip of the ticket on the individual items. So I'd say watch that space on that one.
Okay. And obviously in Australia, you're talking about connecting with a lot of youth audiences or whatever. We've got, social media regulation coming in. I mean, from somebody who obviously deals with a lot of younger consumers, I mean, how are you, the industry, brands kind of navigating, what is kind of slated to come down the pipeline?
With respect to like regulation that we can foresee, if
Yeah,
that's what your question.
the social media where if you're not like 16, you're not going to be on there. But I mean, kind of when you're hitting high school at 14, like that's when like music kind of really kind of enters,
Yeah.
kind of enters, I guess, people's lives for the first time, and they're kind of, wanting to, buy the t-shirts and buy everything. But if they're locked out of even seeing the ads on their social media, their own personal social media, it's going to be hard to reach the first time fan, if I can say that.
Sure. Yes and no, right? So, I mean, we obviously run traditional media through our
Mm.
websites, and yes, we platform revenues and platform enabled growth is important to our future strategy. But it's only a part of the business. It's actually part of the appeal for us in a time where media is, a bit of a, I wouldn't say controversial space, but maybe seen as a bit riskier. We looked at some of these sort of niche publishers and saw an opportunity to run them as profitable businesses, that and play into those strengths that they are standalone media. They're not relying on social media to operate, and that we believe, and the bet that we're making is that folks will still want to associate and align themselves with the strength of those brands. The Rolling Stone brand, for example, is extremely strong, and carries its own gravitas outside of whether or not we're reposting content that we publish there on Facebook, on Instagram, etc. So I think yeah, if suddenly we can't reach some 16-year-olds in Australia, I don't know that we actually care all that much. Also, where we really use social media to sell, it's more on the technology side and the platform side. So we do run ads on for vinyl.com, for example. We push subscription products through Vampr, but the audience there is in the US. So Australia market's important to us on the publishing side, but it's far less important to us on the platform side. And we really only rely on social media and use it heavily for marketing on the platform side. So long-winded answer, but I hope that sort of explains our view.
Yeah.
As far as like what do we think about that legislation, all that stuff, we remain pretty cynical, and we'll see how they actually implement it. I don't see how it in its current proposed form will work, but we're all just standing by to watch that.
Mm. And in terms of revenue splits in the business between Australia and international, wasn't in the slide, but can you give us like maybe just a quick high level breakdown of where, if we take the 20 million goal by FY26, how that should split between Australia and international?
Yeah, I think it's probably easier to talk about the split between platform and publishing. So,
Okay, let's do
yeah,
that.
I mean the publishing revenue will contribute about 30% of that. Sorry, 70% of that goal, with 30% coming from the platform side. On the publishing side, most of the revenue is Australian based. On the platform side, most of it's United States. So, sort of 70-30 is a very lazy breakdown, but it's about right.
Okay. Okay, perfect. And in terms of the structurally lower costs that you talked about, I mean, that's a huge drop in cost if we just take that Q1. What is driving that, or where is that coming from? Is it synergies from, some of the acquisitions, bringing stuff together, bringing back ends together? Maybe just talk through like how you're achieving that kind of drop in costs.
So the bet was always, as I mentioned before, if you buy these profitable media operations, let them settle, find out the best sort of operating cadence, make some tweaks and changes, that we'd be able to use a lot of those profits to not only cover the costs on the more emergent, platform technology side, but really help scale things longer term as everything continues to grow. Um, that we're just seeing that bet is sort of paying off at this point. I mean, the funny thing is, for me at least, we bought a lot of these businesses at the same time. We bought three of these acquisitions in the same quarter last year. And as with any acquisition, you have to sort of observe it for a period of time. So you bring it in. There's quick wins, finance, HR, etc. But once you pass those quick wins, you really have to actually watch and learn from the business. I wouldn't be so cocky to presume that I have all the answers on day one. So part of this process that we're actually, or a muscle, I would say, that we're developing internally so that we can do this all over again, is to what is the best way to integrate a business? What is the optimal amount of time to observe how it operates before you go in and make sweeping changes? We've made sweeping changes. You can do a quick Google and you'll read all about how we've done that. And some people are critical, but I would suggest that that's all just part of growing fast, which is Vinyl's growing extraordinarily fast. I think you go back 2 years ago, our revenues were about $500,000 annually. Today it's much more. So that's yeah. What we're seeing now is exactly what we expected. Is what I'm really saying, and we anticipated probably the extent of the efficiencies that we'd be looking to unlock in each of those cases, and we kind of announced them. If you look back at when we made those acquisitions, we sort of said what we thought the contribution would be to the EBITDA, and I think we're just realizing that right now.
And yeah, maybe just staying on acquisitions. I know you mentioned maybe there's one or two more mastheads that are interesting, but you're very focused on finalizing that integration of what you've done, what you have already acquired. On the platform side, is there any like other kind of tech verticals there that
Yeah.
would be nice to have and bring in, or should we only think of acquisitions in let's say in the next 12 to 18 months on the publishing side, or is it
No,
we can
I'll
expect something
clarify
on the
that.
platform side as well?
Yeah, I'll clarify that because it's actually a really good point. Um, the 1 to 2 mastheads that we that's our target figure each year on the media side, now on the publishing side. That the way we've set up Vinyl Media is hopefully now such that we don't feel necessarily compelled to acquire titles and actually think we're in a stronger position to entertain licensing them and doing those through rep deals. That wasn't really possible a year or two ago. We just didn't have, we didn't have all the pieces in place. But we have that now. So that actually is really exciting for us because we can go out and do these deals, but we don't have to spend a lot of money to get that revenue in. And in theory, just it's all goes to the bottom line, right? Because we've already got all the infrastructure in place. So on that side, I don't think we'll actually be looking. It's possible if something opportunistic comes along, but I don't think we'll be buying any additional titles. I think we'll be licensing some, which means if we're talking about acquisitions, logically that it must be therefore on the platform side.
Okay. And licensing, is that titles that are kind of already up and running in Australia, or is it bringing in uh, you know, titles that you think will, from the US or from the UK, but you think, would find a decent sized audience in the Australian market?
Yeah, we did one this year, which is a good example. So Refinery 29 was a deal we did in I think February or March, and that's an example of a title that had a presence in Australia. Whoever the previous operator was, for whatever reason, wants to leave the market, and we're sort of set up now. We're really the only publisher of our size that's interested in acquiring sort of these niche publications and operating them locally, that's set up, ready to go, and can sort of, I guess, pick up the baton when some of these folks struggle to operate independently in Australia. And it makes sense. It's really hard to operate like a single title profitably in Australia when you've got all these operational costs like finance and HR and all these other bits and pieces, just the general infrastructure needed to run a publishing operation. We're running 8, so we had to work out how to make it work, and the model that we're trying to build here, and again, I think we've kind of proved it at this point, and now it's just hopefully scaling it, is we can sort of add 1 to 2 of these a year, without much disruption at all, and certainly can scale up as those businesses require. So that's the opportunity.
Yeah, and as you say, the like any kind of distribution business, whether it's physical or in the publishing, the more scale you can get in at the top of the juicier the margins, or the more that drops to the bottom line at the bottom, because you as you say, you've that fixed cost infrastructure is already in place.
Yeah, exactly. So yeah, that's super exciting, and I know it motivates the media team tremendously. So watch that space too.
We will indeed. Josh, we're just about up on time, and I don't want to run over. So I think we'll call a halt for today's session there. Thank you very much for joining us. It's good to have you with us on for the first time, and we'll keep an eye on the ASX announcements for anything that might come out from Vinyl Group over the next couple of months. And yeah, hopefully we can get you back in maybe after the next 4C in January, or maybe early March after the half year result comes out in February.
We might well be on a victory tour, in which case we'd be silly not to stop by and say hello, Mark.
Well, we accept victory tours here with open arms. Josh, thanks very much for joining us, and I wish everybody a good rest of Friday and a good weekend. Thank you.